And
Yeah,
what do you think? What do you think? We got some drama today in the Fed?
we'll see. I do think actually on Friday that there is definitely some skew, I think, to downside risk.
For sure.
I think that there's just such a complacency with like, oh, the bond market thinks Powell's just going to pivot, be dovish, and call for rate cuts. That seems like what the Fed Watch tool has on the radar.
Hmm.
But when you actually kind of like look at things from a bird's eye view, we haven't really gotten that signal from Powell. Powell seems pretty stubborn on the inflation side of it. Yes, there's some data that suggests, labor stuff seems to be calming. And I was listening to your thoughts a little bit. I do think that the markets, in my opinion, are just a little too stretched for the potential risks. Like it's almost like the market's kind of just ignoring a whole lot.
Yes.
I heard you mention too, you've got NVIDIA earnings around the corner. It's almost like the market's just so, kind of built up on that momentum of good earnings and things like that. But there are like some serious risks to the market that, we've seen. There was that one time where we were on I think it was December, where you had just a very, very hawkish leaning Powell, and it surprised markets big time. We saw big slides and a lot of things while we were on camera. I think the NASDAQ dropped like 4%. It was crazy.
Was that December last year?
That was December. Yeah, that was December.
Yeah.
And you have those potentials. So to me, I look at the meeting minutes today might have something for us. There's a possibility there. But the bigger possible catalyst is Jackson Hole is historically a time where Fed officials, they make big moves, right? We got the signaling of rate cuts last year at Jackson Hole. So there is that possibility that maybe the crowd shocker could be, either a very hawkish cut or maybe possibly no cut at all until they feel ready, right? The Fed Watch tool went from 99% to 80% or 83%.
Yeah.
Like that.
That would be, that would essentially be, Jerome Powell might as well just have his middle finger up during a press conference if that's what he's going to do. That would be like the biggest like clap back to Donald Trump, where like, you can say all you want, dude, but I'm the Fed chair and this is what we're going to do. Like the market would absolutely hate it. It would be chaotic. And I truly don't think that the Fed wants that.
Yeah.
But it's hard. It's hard to just be like, well, is he just bowing to Trump's pressure? But what I read is something interesting, like even the talk of this like shadow Fed and somebody obviously replacing Jerome Powell when he's done next year, if he sticks out his whole term, is that nobody's necessarily coming in to just do straight up dovishness. Like if a Fed chair comes in is like cut by 50, like that's not going to be good either, because what we continue to do is we're cutting the short end of the curve, not the long end. So the reality is like borrowing rates might not change, man. Like if we're watching the 10-year yield, borrowing yields might not change. And the market's not going to like that either. It's just a weird place to be.
Well, and when the Fed cut, you broke that down perfectly. The Fed controls the short end of the borrowing rate. So the Fed can cut their interest rates. And that's what, Trump and co, they want. They're like, oh, cut the rates. But the long-term, long duration stuff, which is mortgage rates, which is, long-term investing that a lot of businesses do, is long dated debt, real estate, all sorts of things like that. That's pretty much controlled by the market. It's controlled by, the bond market. And so just because the short end gets changed does not mean the long term has to cooperate. In fact, if we look at last year around September, the bond market kind of basically said, hey, that was too much too soon, and we don't actually, we see like potential inflation risks, and keeping rates steady for longer might be the right call. And the bond market was right. The bond market pretty much called that. They said, last year when we started to see rate cuts, the bond market very quickly predicted that we're actually going to hold rates now. Like we need to just not really cut anymore. And it's tricky because I do think that, you have, when you look at the NASDAQ, when you look at S&P 500, when you look at the Dow Jones, they've had just such a remarkable, as you called it earlier, like the turnaround was just so sharp, right? You had the, tariff trade blocking off the rest of the world turned into super growth oriented, all focused on, not disrupting things. And we're going to give plenty of pauses away to other nations that are cooperating. And it really shifted. So I don't know. I think I went into this year, Chris, I was really long gold, and that ended up being one of the better plays that I had this year. I was really long gold, and then I bought stocks in April, well, I bought them in March and April and June. So I didn't play the bottom perfectly, but I felt like that was the right call. And now I do not feel so comfortable buying stocks. Personally, I'm more interested in looking for gold breakouts, looking for pullbacks in gold, and just kind of keeping some cash on hand. I mean, actually, on a personal note, I just filed for a withdrawal from my account because I'm like, I just don't see a lot of attractive stock opportunities right there. I'm doing a lot with options. I'm interested in gold, but I've got a mortgage. So I'm like, you know what? If I don't have anything to put this in or a thing that I really like, I'm just going to throw it at the mortgage and pay that down a little bit. So just things to think about is, opportunity cost of chasing markets that in my opinion are expensive. Sure, they can get more expensive, but that's my perspective. What do you think?
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
Yeah, I'm sitting right around that same 50% that I've been monitoring for the last 3-4 months. It's like I've got dry powder. I'm ready to deploy some capital. I think for me, what I'm going to do is any type of correction that we see, it's not just assume the dip is there. It's like I'm going to play with like a wide 10, 15, 20% buffer. The way that I would love to see it play out would be some type of volatility spike above 20 again. And the reason I say that is because 2022, for example, the VIX was like in a range between about 25 and 35. And we had a pretty solid bear market through 2022. So here's, sorry, my chart's a little bit messy here, but 2022, when we had a 9-month downtrend, this is what the volatility index looked like. We were down to about 18, 19, and then we'd flash up to about 40, down to about 20, up to about 35 or 40, down to 20, up to 35, 40. So we didn't have the outlier 50 VIX or 60 VIX. But what we did have is, if we're about to see like the market's going to have to get a dose of deleveraging, then, but I don't know why would we deleverage when the Fed is like going to start cutting rates? I get we need to deleverage because we're over our skis and this like AI hype is, holy crap, we don't have the energy to actually make all this AI stuff that we want to spend on. It's like, but I think that's almost too forward thinking to have the market not love the optimism right now. I think the market still loves the optimism. I just think that August is always like an interesting month because it's a lower liquidity time. It's usually a summer lull. Most of Europe's on vacation. A lot of people in the US are getting those last minute vacations in, and you're back to the trading desk really in full time, like September onwards. Kids are back to school. It's time to grind. You got tax loss harvests in September. So there's shenanigans, right? It's like this combination of Jackson Hole this week and NVIDIA earnings next week. It's just a perfect time to like rattle the cage. It's a perfect time to just shake up the markets, shake out some of the loose hands that are hoping that the market just go nothing but up. I'm eager to buy some dips, but like I said, I'm probably going to participate in ways like this. If the market pulls back in any meaningful way, like I'd say 5 or 10%, what I'm probably doing is setting up strategies that allow me to either build like a profit trap here and then sell lots of puts down here. I essentially think that I'd be pretty confident if I'm going out to like December, January next year, that as long as I can sell puts at premiums that are keeping us away from the April lows, I think those are pretty high probability trades. Yeah. So for income for me, if I can beef up another, let's say 3 to 5% gains on just selling puts all the way down here towards April lows on the SPY and the Qs, and even the Dow is not offering the same premium, but it's still better. I mean, since UNH, United Healthcare, got its crap together and all of a sudden Warren Buffett's buying it, all of a sudden everyone's interested in that. That's a huge weight in the Dow. Right. So the DIA has been up to all-time highs while the S&P has rolled over a little bit. The Russell, I still think, has that catch-up trade potential because the Fed will be cutting. And that's just an optimism. I mean, like I said, the S&P is 500 of the biggest companies in the world. NASDAQ is just like the top 100 tech companies. Dow is like your blue chips and Russell's your small caps. Unfortunately, there's not enough companies in the small caps to make a lot of money. But as a whole, as we see with the S&P, the best companies raise the whole thing. So if you've got Russell that's performing better, you could have maybe 100 companies in the Russell that could drag the whole 2000 up higher. And I think because it's been such an outperformance of large cap to small cap, it can flip and have like that kind of value play for the short term.
There's a couple things like that, Chris. Like the recency bias would tell you like, oh, you only want to be long, the mega caps, right? The Mag 7, the big guys, you want to be long those because those have been the winners. But to your point, I think that there's it's really easy to look in the rearview mirror in markets, and it's really hard to outperform looking in the rearview mirror in markets. So I've got a couple of things I wanted to show you and to the audience as well. So just to finish my thought on that, right? It's really easy to look at what has been performing really well and be like, oh, that's going to be what I want to buy because that's going to keep going. It's going to keep, and sometimes that does work. Momentum is a thing.
Right.
But as a longer term theme, there's two that come to mind. What you just mentioned about smaller cap companies, I do think that they are relatively underappreciated on a bigger picture. Like I'm talking like next 5 years. I also think international stocks may be underappreciated. But another one that is kind of an interesting concept is actually the Japanese yen on that front, right? We've had this dynamic where the Japanese yen has been like, oh, this terrible trade to be long yen because we've just had the perfect, couple of years where all these banks were hiking interest rates or keeping rates high, but we may be entering into a cycle where the Bank of Japan looks to hike rates and the other banks are cutting interest rates. So the Japanese yen dynamic might change in future years.
Dude, that was literally one of my biggest points in my video this week was this, like I don't love the Japanese yen hardly ever. Okay. Yep. But I will say that if I'm watching the dollar yen or I'm watching the Swiss yen, I think that in this cycle of where we are at right now with central banks this is the bell curve of central banks. The Bank of Japan went from negative to now positive. They're at 0.5%. Okay. Every other central bank was positive that are now cutting rates. One thing I am legitimately concerned about is that the Fed cuts in September and in October and in December and looking like they're going to continue to cut in 2026. And the Bank of Japan's like, we're not going to cut. We might raise to 1%. That would potentially be the unraveling. Like that'd be the same thing we saw like a taste of last summer with that deleveraging and that Bank of Japan carry trade. If that thing unwinds, I mean, like I said, it takes a while for me to get around the yen pair that I really like. But if the dollar yen and I don't know if we're going to get like this, obviously it's seldom going to give us like the perfect setup. But if it breaks this structure here, let me use a trend line. If it breaks the structure, this is dollar yen and Swiss yen are my two that I'm watching. If it breaks this trend line, okay, I think if we break, retest, and go, I'd love an entry in here with a stop loss above. And if it's going to go to 140, that's an awesome trade. If it breaks 140, Nick, we're going to 120. And all I want to do is set a stop loss at break even and then walk away. Because as long as I'm not risking anything, I'll let the Japanese yen go thousands of pips. I don't care, but I just don't want to risk anything.
Yeah, let me show you this this chart, Chris.
Yeah,
I've got a couple charts. I'm loaded with charts today for us. So just to your point about the Japanese yen, that to me is also something I think it's really hard to time these things, but like when it goes, it will go. And if you get some sort of true risk off environment, here is the US, the UK, and Europe's projected interest rates going forward. So these are forward projections we've gotten into the Edge Finder across a couple different central banks. So when we look at the US, right, you can see the blue bar kind of over the next few quarters is expected to decline. When we take a look at the UK, they're expected, though they're trying, they had a hot inflation print today, but they're trying to also cut interest rates. And then you also have Europe, right? Europe wants to, they've already been cutting interest rates, but they want to keep those rates steadily moving lower. And then comes the Bank of Japan, which it's not a huge, but look at the difference in direction. Yep. They're looking to hike interest rates. And so you've lived in this world where we've all been like, oh, the Japanese yen is just a big loser. It only goes down. And it's the great carry trade that's been going for some time. But that can change. And that's where markets are tricky, is because everybody gets used to the status quo. But this dynamic, if this plays out as accordingly, you may see some strength in the yen relative to other currencies. I mean, the dynamic here where they're cutting, Bank of Japan is hiking, could cause some surprise to the upside moves in Japanese yen. I mean, Chris, a year ago, that was what caused the big slide in August. We all forget.
I know. That
is a serious force in markets that can be woken up again. And so, you kind of may have that perfect storm where a couple of these things overlap, where you have a very expensive stock market, Bank of Japan is hiking rates. So I'm definitely cautious on that. I think those I'm not necessarily willing to go out and short the indices heavily. I rarely am, but I do think it's worth keeping some cash on the sidelines and being defensive, especially with a market that has been pretty much straight up to the right. I've got one other chart I want to show you here really quick before I forget to do so. It's seasonality month over month for the S&P 500. So this is something we've talked about for a long time, but we do have some seasonality expected. That in September, we're expecting a little bit of softness based on the last 10-year historical average. August has been okay. Longer term, it's not been as good. It's been kind of a wash of a month. But then also take a look at this. I actually bought some calls on the VIX, Chris, a couple days ago.
Okay.
And part of the reason for that, I don't, and it's more of just a hedge. It's not a big position for me, but I bought some out of the money calls on the VIX with the idea being that we're entering into, as you pointed out, that back to school period where people are back on the charts and maybe doing some tax loss harvesting, et cetera. In markets, you can often get some volatility. One other thing that's interesting about this seasonality phenomenon is that I read that a lot of the share buybacks, which have a huge impact on performance of markets, share buybacks are slower during this period. So I thought that was kind of interesting. But just some food for thought. You're entering into a period where you may get some higher elevation volatility than we have had. This has been true to form here this year. Volatility has been low in May, June, and in July. So we'll see how things progress. Perhaps we do get a sharp rise in volatility. When those things happen, they can be very quick, right? So if you pull up a chart of the VIX at any point in history, you can see we get these stretches of time where you get the low volatility range, and then all of a sudden you get these huge spikes in volatility. Last year we had, well, in the last 1 year really, we had two, which was pretty exceptional to get massive spikes in the VIX like this. Is that a phenomenon that's going to continue? Are we getting these kind of short bursts in volatility? I don't know, but we'll see. I tend to think we may get something that's a little bit more real and lasting at some point, a longer term downward market, but we'll see. Right now for longs, but hey, you know what? We'll see what happens. Very nice. Congrats. Gold itself has just been a boring nothing burger for the last few months. I've gotten a lot of requests, obviously, like, hey, Nick, what are your thoughts on gold? What are your thoughts on gold? I get that comment like actually probably 100 times a day. But there's just a point where you're like, okay, look, things not moving, move on to something that is, and there's very few things that are moving. However, all of that, ladies and gentlemen, can change in the next, it could change in the next 1 minute. We're about to get the meeting minutes. I'll keep an eye on what that brings, if it brings anything of interest. Just a heads up, I know people are going to ask, are you turning on the speech? There is no speech. The meeting minutes are just meeting minutes. They are notes from a privately held discussion between Federal Reserve officials. This is not a Jerome Powell on the press conference. That will be on Friday. He's got the Jackson Hole Symposium. I will be doing a live stream for that. That's going to be big stuff. We'll see if anything happens. I'll tell you what, most of the time, meeting minutes do not move the market. Every once in a while, you get something that shocks the market. That's what we're gathered here for, to see if that does anything big. Let me see if I can make this a little bit bigger. Keep an eye on some markets here in the background too. Majority saw inflation risk outweighing employment risk. It's a little bit more hawkish to start out here. Let's see what we've got. Just see if I find anything that sticks out to me. Although swings in net exports continue to affect the data, recent indicators suggest that the growth of economic activity moderated in the first half of the year. The unemployment rate remains low and labor market conditions remain solid. Inflation remains somewhat elevated. So right off the bat, a little bit more pointed towards labor data looks okay, inflation seems elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks of both sides of its dual mandate. In support of its goals, the committee decided to maintain the target range for the federal we know that, and considering the extent and timing of additional adjustments to the target rate range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to supporting maximum employment and returning to the 2% target. Okay, let me just see if we are seeing a little bit of downside movement in the indices. Gold is just ever so slightly lower. Dollar index just slightly higher. Thank you, Othman, for sharing that. Many noted full effect of tariffs could take some time. That also sort of could be taken hawkish or dovish, right? You could argue, oh, that's going to cause inflation down the line, so we shouldn't cut rates. And then you could also say, well, it could worsen the economy, could hurt the economy in some way that we're not thinking, that could cause unemployment to spike. We should cut rates. So there's sort of risks to both sides with that. Concerns about elevated asset valuations. Yeah, the other thing you have to guys remember, the stock market's at like all-time highs. It's pretty close. So the Fed does not feel, believe it or not, as much as they say they don't look at the stock market, the Fed totally does look at the stock market. Actually, they don't say that they don't look at it. But they wouldn't say directly, oh, the stock market's selling off, that's why we're going to cut rates. But that could be a serious reason as to why they cut rates. Some participants said it would not be feasible or appropriate to wait for complete clarity on the tariffs' effects on inflation before adjusting monetary policy. Yeah, so in the notes so far, it kind of seems a little bit hawkish. Very interesting. Dollar slightly up here, gold lower, stocks mixed. I mean, the Dow Jones taking a little bit bigger of a hit, Russell taking a bigger hit. Let's take a look at yields here. Yields were down a lot more this morning, so maybe a bounce in the 10-year. A little bit, not much though. Individual stocks. NASDAQ down 1% today. So, and you know, there are times where down 1% on the NASDAQ is absolutely nothing, but recently that's a big move. You've just had such low volatility. Why is the statement you have from the 30th of July? The meeting minutes are posted later than the actual meeting. Where can I watch the Fed minutes? Like I said, it's not a press conference. Jerome Powell's not speaking right now. It's a publication of a document that I just pulled up on the screen. So this is the Fed meeting minutes. It's not a press conference. The Fed's policy is to say nothing, circle back and repeat the nothing said, then end on a nothing was said note. There you go. Fed meetings came back hawkish, likely further down with more volatility when Powell speaks Friday. Sam, I would agree. It does seem like the Fed meeting minutes just came in just a touch more hawkish than perhaps expected. I mean, what we wanted to see here, or what we do want to see, I think, going into Friday, and this to me signals you might get more of a chance that Powell may be a little hawkish on Friday. You want to see them saying, we very much think there's a risk to employment data and inflation. But this line says a lot to me. The unemployment rate remains low and labor market conditions remain solid. Inflation remains somewhat elevated. So I guess the one thing you could point at though is that if this is 30th of July and you get, you had that abysmal jobs number that came in a couple days later, they may revise this and may come in across a little bit more dovish when we hear from Powell on Friday. But we'll see. Does hawkish mean up or down? Hawkish means that the Federal Reserve is less likely to want to cut interest rates. Dovish means they're more likely to want to cut interest rates. Dovish is generally bearish for a currency, bullish for gold, bullish for stocks. Hawkish is generally perceived as more bullish for the currency and bearish for gold and stocks. But yeah, yields here still kind of staying steady ahead of the Fed meeting. There's to me a potential that you get, or not the Fed meeting, the Jackson Hole Symposium. To me, there's the possibility that Powell will really take the stand and he'll say the Fed should be independent. The president can't tell us what to do, and we're not going to cut rates. I don't think he would say it that way, but that to me seems like you might get that surprise. A lot of people are thinking that Powell is going to pivot dovish. There also is the possibility that he issues signals a dovish cut in September. I'm sorry, a hawkish cut, where he says essentially a one rate cut might be appropriate as the data falls, but that they're unlikely to see 2 or 3. He may not say it in those exact words. The market obsesses over every little thing he says during these sorts of events. But that would be what people are looking for, is a hawkish cut, meaning we may cut rates, but it's probably one and done. But we'll see. Will the Fed meeting have an impact on the probability of rate cuts? So yes, very likely. That's why this week the big event is Jackson Hole. Jackson Hole is it's just a big, yearly Fed event. And I've mentioned this many times, but historically that is a time in which the chairman can kind of like leak out or show a little bit more of what their plans are on stuff. And so it's very heavily anticipated. You may get a Powell that comes in swinging on the hawkish side saying, we're still struggling with inflation. There's too much risk to the inflation side. Or you might get a more lenient, like, hey, the jobs data is also looking soft. Maybe we should cut rates. Or you might get kind of the somewhere in between. We see a little bit of risk to both sides. Maybe a cut is appropriate, but we don't see too much need to do so. So that would be more of a hawkish cut. So that's what we're looking for on Friday. Everybody who's here, we got 1,300 people. On Friday, we're going to be streaming that event. It's probably the most important event that we've had in quite some time. It is Jerome Powell's last time doing the Jackson Hole Symposium. Is there the small tail risk that Powell makes his stand against Trump and says, essentially the Fed should be independent and presidents shouldn't be able to kind of like bully Fed officials? Is that something he would try to state, or would he kind of more just say, hey, look, data looks a little bit mixed. Maybe we should cut rates. That's why it's up in the air. That's why the markets are going to be really volatile, in my opinion, on Friday. I think you could get some very surprising moves on Friday. Let's take a look at some sentiment here in the room. Crowd sentiment has been kind of mixed. We are going to get the latest AAII investor sentiment survey. That will come out tomorrow. So keep an eye on that. If you have the Edge Finder put to call ratio, I'm really curious to see what it looks like after the bell here today, what crowd sentiment is looking like for that. We also, if we take a look at institutional positioning, I find this to be really interesting, guys. You have recently seen selling in the dollar, right? Look at the yellow line. The yellow line shows you institutional positioning week over week. Yellow line has been trending lower, right? So institutions have been selling the dollar. You know what else they've been selling? I find this to be really interesting. S&P. Kind of a net selling here in recent times in the S&P 500 from the Commitment of Traders report showing institutional flows. Gold's been kind of trickling higher.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.